There. Was that you or me? Okay, so set that down. You're gonna, okay. So yeah, I'm gonna cover some general CalPERS information up front. I don't think there's anything earth-shattering here. And then I'm going to cover investment returns and we kind of delve into a little bit amortization policy and how the investment returns are promulgated into your contribution. So next slide. Just a general slide about CalPERS. Sometimes it seems like they're making stuff up, but the reality is that there's a public employee retirement law that they're bound by. The board then has discretion in certain areas and they set policies, staff follow them. So there's not a lot of, open area. Certainly there's some interpretation and some leeway for how they do things, but overall, they're following a board policy essentially. Okay. Real briefly, CalPERS board has a number of different. It's working now. Okay. There. They have a number of different appointed members. The one thing I'd point out here is there is no direct representation for public agencies, right? The public agency members have a vote in a CalPERS board member, but the agencies themselves don't elect a member. In theory, I shouldn't say in theory, but you have your voice at the CalPERS board meetings to the extent you want to be heard on issues, but unfortunately there's no direct position on the board elected. Most of you are probably CalPERS members, so I don't think I'll talk a little bit, but just a little bit of background on how benefits work. At retirement, for example, if you have the miscellaneous 2.5 at 55 formula, the benefit you get from your agency will be 2.5% times the years you work with that agency times your final pay. The one factor there that doesn't depend on your agency is the final pay. If you worked for 10 years at your agency, left, worked for another 10 years somewhere else, when they go to determine what benefits paid from your agency, it would be the final pay, the highest final pay from any agency you work for. So it's what's known as reciprocity. That's just the way the system works. There's also typically a 2% COLA. There's an option to have a higher COLA for the retirees. And we'll kind of come back to that later. Almost all agencies have 2% COLAs. This is from the CalPERS 2023 risk assessment report. There's a lot of information we pulled in from that report from CalPERS. I think a lot of numbers here, a couple million members, as you can see there, 440 billion in assets. This is June 30, 22. Obviously, we're ways down the road from that. June 30, 24, I think they were over $500 billion. So ultimately, one of the points here is awful big system. As you can see, the last several lines there, 29 billion in contributions that have come in. And we'll kind of drill down on that a little bit in the next slide. But then you also have I'm sorry, picked the wrong number. The benefit payments, 29 billion. You have the last two are the employee contributions. And in terms of the contributions, of course, as you know, CalPERS sends the bill each month. There's also the ability to pay discretionary contributions. And this again is from the CalPERS annual risk report. What this is showing is how much were made in additional discretionary payments over about a 7-year period here. The light blue are just typical additional payments that are made to CalPERS that then separated how much came from POBs, pension obligation bonds. So you can see here the spike in the POBs, the orange columns there in 2021 and 22 as interest rates dropped. If you go back to 2017, you don't see any POBs. If we were back at that point in time, I thought POBs were dead in the water. I didn't think we'd see them again, right? You have the GFOA white paper saying, don't do it. It's risky, it's complicated, stay away from them. Interest rates dropped so low that a lot of agencies issued POBs. What's not clear is why, if you coming back to the additional discretionary payments, why there was such a big drop off in 23. You can see it's averaging around 1.1 billion per year in 21 and 22. 23, it dropped off quite a bit. I know a lot of agencies work with are at this point facing some budget constraints. I don't know if that has to do with what happened there, but again, these are contributions in addition to what's required by CalPERS. And then one last brief overview. This is basic, but it's really important to keep in mind. What you have on the right side is what does CalPERS have to pay out? They have the benefit payments, which is the red. They have some small level expenses, really small. That's what they have to pay out. Where do they get the money for the payout? It's on the left side. On the left side, then we have that broken out by really there's three sources. There's the green contributions, whether that's employees or employers, and then investment income. So this, the proportions here on the left side are from CalPERS. So basically saying that, 3-to-1 on the employer to employee overall in the system, and that 56% of what they pay out is developed through investment income. So I want to then talk about returns, and we're going to run through an example of how the returns, when they fall short or exceed the expectation, how they get pulled in to your contributions for the amortization policy. This slide has historical returns CalPERS has generated over about a 30-year period. The green is the annual returns, and we have kind of the highlight on the markers there in terms of kind of the extreme years. The colors here, the blue, which we'll come back to later, is the discount rate. So that's kind of the expected return. And then the red is a 10-year average of the actual return. So if you look at the light green, it's kind of hard to tell what's going on. The red kind of gives you an idea on average how have they been doing. We'll come back to the final 5 years here a few slides later, so I won't delve on that. But the point here is you probably well aware a ton of volatility, and we're going to talk in the amortization policy how CalPERS deals with that volatility. Overall, they've done, I'd have to say fairly well, right? 10-year average return 6.2, 20 years 6.7, and 30 years 7.7. So that's through June 30th, 2024. Okay. So discount rate, I just think this slide is interesting. What you see here is over a 30-year period, roughly, the upper line is the discount rate CalPERS has been using in the valuation. So you go back 30 years, they were assuming an 8.75% return on their funds. That's come all the way down to 6.8% currently. But what you see below there are the components. So when actuaries develop a discount or expected return, they look at what's expected inflation, what's the expected real return, and combine those to get to the total return. The components, those two components, the inflation and real rate of return, are the purple and green lines there. So if you look at that, what's happened here is not really that CalPERS has lowered much their expected real rate of return. It's that their inflation assumption has dropped dramatically. From 93, it was 4.5%, down to the 2.3% they're using today. So they have had, over the last 5 years or so, they did slightly drop, as you see in the green line, their expected real rate of return, kind of expecting that the markets won't do quite as well as in the past. But most of the decline you're seeing there is really from an adjustment to inflation, but also big drop, 200 basis points over the period. In terms of how CalPERS invests that money, this is as of March 31, 2024. I just wanted to touch on this briefly and to give you an idea of how the money is allocated. And also because if you look at the red circle items there, those are privately held investments. So every year CalPERS announces a return in July. And that's really, although that gets quoted a lot, and it's actually what we used in the previous charts we're looking at, those numbers are preliminary. And CalPERS then drills down on these private investments, and in their financial statement that's issued in November, they revise that return. So there's kind of these two returns floating out there with respect to each year. Okay, so this chart shows the last 5 years for a couple of reasons. One, because I wanted to drill down a little more on what's happened in the last 5 years. And also, we're going to look at how these returns have populated your contributions going forward. The other thing this shows is we're graphing here again those initial announced returns in each year, announced in July. What is showing in the box is also what the final actual return was in each year. And as you can see, it's varied. It's not as though there's, I would say, any kind of bias in terms of how CalPERS announces that July amount, which gets a lot of press. What actually ends up happening is something a little different. As you can see, that last return that was announced June 30, 24, 9.3%. Of course, we don't yet know what that final number is going to be yet. So I wanted then, with the volatility, talk about how CalPERS pulls that into your contribution. So this is an illustration. Suppose your agency has 10 million in assets, and there's a 10% investment loss, which would mean about $1 million on that 10 million is a loss. Here's the way CalPERS pulls that in to your contributions. You basically owe $1 million more than they anticipated. They're going to have you pay on the blue dotted line. So they're using what's known as a ramp up on the amortization payment. So you start on that $1 million with a $20,000 payment. And at the end of 5 years, you're somewhere around $110,000. You pay that for the other 15 years, and then you're done. Okay. The dotted line is if CalPERS had just used a level amortization, said, okay, pay the same amount every year. Of course, now they don't do that. And the reason, of course, they don't do that is because of to help to control volatility, right? You have a $1 million loss, you would have for each $1 million of asset loss, a $90,000 payment immediately, big jump. So they try to grade you into that. What's the drawback to that, right? Why not just do that? Why not just even out contributions? Well, this next slide shows the balance on that $1 million under the two amortization policies, right? So if you've done level dollar, you have the dotted line, you basically go from the $1 million down to zero over 20 years. Everything looks pretty good. With the ramp up, what you have is an increase in that balance initially. For 3 years, you have that balance increasing. It's not till 6 years out that you end up with a balance on that less than $1 million. Okay, so that's the drawback to having this ramp up policy in place, is that you have the potential that you're going to end up not paying down the liability quick enough. Oops, sorry, I jumped too far forward. So, that concept, the term negative amortization's been used, right? Means that you're paying less than interest on the amount that you owe. So your debt, or that base, essentially that base represents sort of a debt, increases each year initially under negative amortization. And it's a trade-off, right? It's a method to stabilize the contributions. The drawback, of course, is what we're looking at with the negative amortization. So how much of that goes on at CalPERS? Well, again, from their 2003 risk report, what this shows is for public agencies by year, the percentage of plans that have negative amortization on their unfunded, so are paying less than interest and have that balance expected to grow in total. We're not looking at just say one base, looking at in total. And what you see here is, now keep in mind, there's this 2-year lag between the valuation and when the contribution comes in. So if you see 23, 24, 0% of the plans have negative amortization. There was a big return in 21 that resulted in a big gain, and there's no negative amortization. 22, there was a loss, and now you can see almost a quarter of the plans have negative amortization, or have it for this year, for 24, 25. The lighter blue lines are then what are projected out. So 18%, then 11%. Those are light blue because they will vary, of course, depending on what happens, going forward with the investment returns. So I want to drill down a little bit on kind of how this happens with the amortization policy. And this is an example that we kind of ran through. Now, at this point, can assume you have 10 million in assets with CalPERS at June 30th, 2019. Then we kind of run through each year and the investment returns and how that gets pulled into your contributions. I might also say if I thought about this a little more, I might have done 100 million. I think 100 million, 130 million at June 30, 22 at least was the average assets for an agency. So, if you're looking at dollar amounts here, these numbers probably typically lower than you'll see for most agencies. One of the things not included in this is something called tail volatility, which means you look at the amortization schedule in the 20 years, that drops off a cliff, right? Now, if you get a credit, for example, at the end of the 20 years, you have this big credit that disappears and your contribution jumps back up. So the tail end, you're going to have some volatility. At this point, this illustration is just really focused on what happens initially as you run this out. So on the $10 million, June 30, 19, we have there the returns. Now at this point, we've switched over to the actual returns that were published later in the year. So for example, that second row there, 2021, they published 21.3, I think it was. The actual return was more like 22.4, so that's what we're using. And as you have the $10 million, small loss in the first year, $180,000 loss. The second year, it's about $1.6 million loss gain. So we're going to see how this gets pulled in to contributions going forward. So here's the first year. You have that minor loss. The blue line is showing that ramp up. We'll kind of keep the scale the same on all of these graphs. So it might be kind of hard to see this. If it were just doing this, we'd do the scale different. But what you can see is that initial 5-year period ramp up from that loss in the 5% return in the first year that hits in the 2020 contribution. Go to the second year. What happens? Well, now we have a second. See if I can do this. Oh. Jump. Never mind. I want to try to use that high technology there. I didn't. Anyway, second year now, you have that first line, and now they have another layer, the second, the lower blue line that starts a year later. If you total the two together, you get the red. Okay. So 5% return the first year, followed by great return the second year. Great return the second year gives you a credit, right? The combination of the two gives you the red. We go to the next year. Now we're 3 years in, right? You can see that was a poor return year. We've got a loss coming in the third line. That jumps up again. The red is the average or the total of the 3 lines. Fourth year, we have a little bit of a loss. The red line shifts up. And finally, we get to the end of the 5th year, okay? And you can see we've got a lot of stuff going on. The blue lines are staggered over time. They're jumping all over the place. But you can see the red line is sort of stabilizing things somewhat, right? And there's not a ton of volatility there. So the method's working. But let's come back to that issue of negative amortization in the final slide. So the red here is what we were showing before in the previous slide for the what the totality impact of the investment returns is on the amortization policy. I guess it's orange. Could have picked a more contrasting color there, but the orange is interest on whatever the unfunded balance is. So what you see here is, the second data point there is a little confusing because at the end of the second year, if you recall, that was after the 22% return in 21. So there was a big gain and you have a credit. And so actually they gave you less of a credit, the red line in the second year, than the interest, right? So they gave you a lower credit. But focus on after that point in time, after the second year. What you see there is the red line for a number of years is below the orange, right? And the orange again represents interest. So what that's saying is you look at just investment losses since 2019, the amounts they're having you pay don't cover interest on those investment losses over the years. And even more than that, the interesting thing is if you look at this interest on, let's take again, it's like basically year 3, maybe what is that, 3 through 3, 4, 5, 6 through 28. What you see there is interest on the unfunded is the orange line. That's a positive number. CalPERS is giving you a credit on your contribution, right? So that's kind of a very odd thing. You know, you have basically have an unfunded, but they're giving you a credit for that amount. Now, this is an illustration to try to explain how this all rolls forward. If you had no unfunded liability, perhaps at June 30 of 19, then these would be your numbers. But obviously you have an unfunded at June 30 of 19, and most agencies do. So there's a whole nother layer of components here. And this is not necessarily, it's not gonna be exactly how this negative amortization issue rolls forward on your CalPERS contribution rates. But it gives you an idea of how this is working, how it will work through your rates going forward. And let's see, remember there's one last point I wanted to make here, but oh, okay. So, you know, look, overall, you know, as a firm for OPEB, for example, we use ramp ups on some of our plans. I don't want you to walk away from here thinking I'm saying the ramp up is a bad thing. I think it's a good thing. I'm just saying, be aware there is this issue, right? And if you go back to that slide from the risk report, you're looking at for next year, maybe a quarter of you in the audience here have plans where you're not going to be paying interest on your unfunded. Kind of gets back to additional discretionary contributions and something you should consider. As I said, you know, a lot of our clients are looking at kind of budget constraints at this point in time, so that may or may not be something on the table, but it's something that you should certainly be aware of. Okay, so that's what I had. We have some other sections, I think, to make sure we get through the material. I'm gonna turn it over to Kateryna at this point in time. Yeah. Yep.
Good afternoon. My name is Kateryna Pryor, and I'm a consultant actuary at Foster & Foster. And I've been working on GASB 68 reporting for cost-sharing risk pool clients for since 2016, pretty much since implementation of their statement. And every year we prepare around 100 reports. And what we've seen in the last several years is very weird results for pension expense for GASB 68 cost-sharing clients. And that's what I want to talk about in more details, why we see those results and what makes sense. But before we talk about that, I do want to set a stage. There are basically two types of agencies in CalPERS. Smaller agencies with less than 100 active employees in each rate plan are pulled together in a cost-sharing risk pool. And that discussion is going to be more relevant for those agencies. And there are bigger agencies with more than 100 active employees in each rate plan. Those are standalone agencies. And unlike their smaller counterparts, you guys actually get reporting for GASB 68 directly from CalPERS. For smaller agencies, those in cost sharing, you are actually tasked in calculating the entries on your own. And that's what we do for a lot of our clients. And before we actually delve into intricacies of GASB 68 exciting world, I do want to conduct a brief survey. Can I please have a show of hands from people who are in cost-sharing risk pool, who are smaller agencies? Great, we have quite a few. The great news for you is my short presentation is going to be relevant for your reporting and hopefully will help you to make sense of the numbers. Okay, can I please have a show of hands from people who are from bigger agencies, those that are standalone agencies with more than 100 active employees in rate plan? Okay, the good news is this presentation is very short. I'm not going to bore you to death. Please hold on. And of course, third but not least, how about people who are not quite sure if their agency is in cost-sharing risk pool or standalone plan? Can I please have a raise of hands? Okay, no one is saying that, but I bet there are people. And if you don't know, good news for you, you're lucky. You're not the ones dealing with this mess for your agency. Okay, now I want to start with examples. And the numbers I'm going to show in my examples are actual numbers we calculated for our agencies. And first, I want to talk about pension liability, net pension liability. Quick refresher, net pension liability is your pension liability minus assets set aside to pay off those liabilities. Simple, right? When we talk about GASB 68 reporting, keep in mind there is 1 year lag, meaning that when we look at 24 reporting, we're actually reporting numbers as of June 30, 23. So there is 1 year lag you should be aware of. Okay, and the last point I want to make is there are a lot of factors impacting your net pension liability. However, what we've seen in the last several years is that all of them were dwarfed by huge investment gains and losses. So investment gains and losses in prior years been major factor impacting ups and downs on net pension liability. And just to highlight that point, look, okay, I'll try to figure out. Okay, now I'm gonna skip that. Look at the difference between 21 and 22 reporting. There is a huge drop in liability and actually flipped to an asset. That's because of very good return on investment in 2021. It was 21%. And in 23, it flipped back to liability of 4 million, huge increase due to investment loss of 6% CalPERS had in 21-22 fiscal year. Okay, 24, upcoming year, exciting. There is a slight increase. Okay, 1 million is not slight, but it's nothing of the magnitude we saw in prior years. So that's what we tend to see. In 2024 reporting, you can expect your net pension liability to go up, but not as drastic as we've seen in prior years. And I want to use this opportunity to stop and talk about upcoming year, 2025 reporting, because CalPERS already published their preliminary report, preliminary investment return of 9.3%. So what does it mean for you, right? Because of the timeline, we actually can predict a little bit what can we expect in 25 reporting. So 9.3% is great. It's just 2%, a little over 2% over what it was expected. So what does it mean for your net pension liability? Remember, it's difference between liabilities and assets. Your assets went up, so your net pension liability will go down. That said, if it was in a vacuum and there were no other factors, I would say that you should expect in 25 reporting to see your net pension liability either very close to 2024 number or even lower, a little bit lower. However, there are still factors we don't know. There is still experience that can be either positive or negative. There are still little things that can happen to you or the entire risk pool. So I wouldn't take it for granted we're going to see a drop in net pension liability, but at least we can expect the number to be stable and very close to the current year reporting. So that's a good news. We are not expecting big flips up and down as we saw in prior years. I think we all can take a break from that. Okay, those numbers make sense. How about pension expense now? That part does not make sense. So look at the numbers. First of all, well, it's good. For the first 3 years, at least it goes the same direction as net pension liability. It goes down when net pension liability goes down, and it goes up when net pension liability goes up. Not the case in 2024 for some reason. It actually goes the opposite directions. It drops in half when net pension liability goes up. Okay, that's interesting. Let's look at one more example. First, net pension liability. Higher liabilities, but same pattern because of the investment returns. We see dip in 22, goes up 23, a smallish increase in 24. Okay, what about pension expense? Anyone want to take a guess? I dare you. If I didn't know anything about GASB 68 question, I would say it should follow the same pattern as prior example, right? It should follow net pension liabilities ups and downs, except 24. I don't know what happened with 24, right? Let's see. No, actually, exactly the opposite is happening. Look at that. So Oh, okay, I'm sorry. What happens is when we see a drop in liabilities in 22, pension expense actually goes up from 9 million to almost 13. When liabilities go up again, pension liability flips to an asset. And 2024 reporting, we see a big pension expense. It makes no sense. Okay, let's look at one more example. Net pension liability. Again, same pattern, different numbers, same pattern. What about pension expense? Well, pension expense follows the same pattern as in the first example. Look at the magnitude. Look at the changes in net pension liability, for example, from 22 to 23. So it flipped from 9 million in assets to 2 million in liability. Look what happened with pension expense. 13 million in asset flipped to 16 million in liability. If that makes sense to you, it doesn't to me. So to try to make sense of it, we do need to look a little closer into how pension expense is actually calculated. So here's an example. This is an illustration of how pension expense is calculated for cost-sharing agencies, for GASB 68 reporting. In its nutshell, pension expense is a difference between net pension liability at the beginning of the year and end of the year. However, there are certain factors that already impacted your net pension liability, but will go through your expense over time. They're called deferrals. So GASB wanted, for cost-sharing agencies, GASB said that everything should be allocated based on allocation percentages from the whole. Okay, straightforward. However, CalPERS added a twist to it. CalPERS really wanted to match their funding numbers as close as possible. And to achieve that, they developed an interesting approach. They're using 3 different allocation percentages. And that was not prescribed by GASB. That's specific for CalPERS. So I'll show you what that means. When we calculate net pension liability, we use 2 percentages, one for liability and one for assets. Okay, but then we come to deferrals. What happens? We use a 3rd percentage, which is NPL percentage. So what that means is when we go to deferred outflow and inflow for investments, gain and losses, we actually use NPL percentage to allocate it. So when you have a good investment return and you have gain in assets, you're actually using that NPL percentage, not the asset percentage you use to calculate NPL, which would make more sense, right? Investments are related to assets, use the same percentage. Well, that's not what CalPERS is saying to do in GASB 68 calculation. So what that means is that creates imbalance. And we've seen that imbalance throughout all of the years. But what happened in 23 and 22 and 23 reporting is that huge investment losses and gains highlighted that imbalance so much more. It became very prominent. It resulted in those very weird results we saw before. So now that we understand how pension expense is calculated, I do want to go back to the numbers, to the examples I showed before, and let's look at their allocation percentages used. So in the first example, liability and asset percentages are very close to each other. Typically, when we see that, numbers make more sense. However, look at the deferral percentage. It's much smaller than other percentages. Okay, that means that particular agency gets smaller portion of deferrals. But to make it even more interesting, look at the 2022 column. It actually has negative sign. What does it mean? That means that when we recognize an investment gain, we actually report it as an outflow for deferrals, which doesn't make any sense. It flips the sign. That's why you see such weird results with pension expense. Okay, how about the second example? You see bigger difference between allocation percentages for liabilities and assets. It might seem small, those are percentages are small, but remember they apply to very big numbers, so even tiny difference makes a difference. But look at their deferral percentage. For example, in 2022 column, it's double that of the asset percentage. So while we allocate asset on 1%, we allocate double that share of investment gains and losses. Make sense to you? No, it doesn't. And that causes a bigger bigger difference between changes in NPL, net pension liability, and pension expense. Okay, and the third example, the most extreme one, it not only has big difference between liability percentages and asset percentages, it also has sign flipping. So it has all of it. That's why you see such a huge variance between pension expense numbers compared to net pension liability numbers. Okay, that was brief and very technical information on particularly cost sharing and calculating of pension expense. I understand you won't remember everything, but I do want you to remember that for 24 upcoming reporting, it's kind of better year. There is not a lot going on, and net pension liability will likely go up a little bit, but not much. And 25, it's gonna stay approximately on the same level. And pension expense just doesn't make any sense. That's the bottom line. And after that, I do want to briefly cover on OPEB. That's typically a topic not covered as much, but it is still important. OPEB is other than pension post-employment benefits. And that would typically include medical, dental, basically all healthcare. And there are a number of providers for healthcare benefits, but I'm gonna focus here on CalPERS because it's one of the biggest providers of medical benefits for public employees, and it only second to federal government overall in the country. But please keep in mind, wherever your provider is, those issues will be relevant to you as well. So a little bit on CalPERS healthcare. So they provide benefits for almost 1.5 million people. It's a lot. But the important thing to remember is once you contract with CalPERS, you don't have any say in how premiums are structured, benefits, or anything else. What happens is CalPERS Board of Administrations gather annually and they decide on co-payments, availability, everything. And why that is important is that just last week, they published their 2025 premium rates. And that's bad. It's really bad. Okay, for basic plans, the increase on average is just a little over 9%. So not too bad, but it's higher than even our conservative assumption is. So but a little, like several percent higher. So what that increase means for you guys is that most agencies do pay a good chunk of your active employee premiums. So that increase is going to hit you because you're paying premiums for your active employees. But it's also going to impact OPEB liabilities, but not as much because the increase is not as drastic. Okay, let's go to Medicare. 22.25. It's really bad. 22.25 increase overall in Medicare premiums. And that's going to impact your retiree population. If your agency is paying a significant portion of post-65 premiums and you're in CalPERS, you need to know this because that's going to hit you hard. And you need to keep an eye on that for your 24-25 budgeting and 25-26. And CalPERS did provide several reasons for that increase. Of course, they're not immune to inflation. They're also citing increased utilization of specialty medication. Also, they're doing some restructuring, also they're expanding services, all of that stuff. If you're interested in details, please, I would encourage you to go ahead and find that article from last week, I'm sorry, and read it in more details. And specifically for Medicare, premiums, they're citing change in the way federal government reimburses for Medicare premiums as a cause for increase in the prices. Okay. I do want to look closely because I'm an actuary. I cannot just take an average number and go with that. I want to look at numbers closely. So for this table represents increases for each plan. And for basic plans, yeah, there are some outliers that are like 12 to 15% increase, but still it's not a huge range. Hold on. Medicare. Look at that. Yeah. So if you happen to be unlucky agency that has a lot of retirees in PERS plans or United Healthcare plan, you're going to be hammered with 30% increase, not 22%, 30% increase. But if you're lucky to have most of your population in Kaiser, very different story. Your increase in premiums will be under 6%. Again, I'll remind you, that's only for Medicare. So my point is, don't just look at average 22%. It's not representative. If you do provide OPEB benefits for retirees over 65, please look at the census. Look what your retirees are selecting for their plan, and look at this table from CalPERS to estimate how much more you will be paying in the next fiscal year for your premiums, for your pay as you go. It's going to hit your OPEB for sure, liabilities, but also going to hit your budget. Okay, that was a bad news, but I really wanted you guys to know that. Slightly changing the curves, still staying on OPEB. So if your agency is not pre-funding, you have to use a discount rate based on high quality municipal bond rate. And most of our clients are using Bond Buyer 20. That's the one in thick blue line. And the good news is that for the last 3 years, we've seen a steady increase. And as of 6/30/24, the rate is standing at 3.9%. So it's good. Higher discount rate means your liabilities are lower. And it's so much different from low 2% back in 2021. If you're funding, that's a different story. If your agency is funding OPEB benefits, you can use higher discount rate. Based on your level of funding, you might even use full discount rate, meaning discount rate that is equal to investment returns you expect in the future. Again, there are different providers you can contract with for your OPEB trust, but again, CalPERS tend to be the most popular. So, and we have numbers for them. That's why I'm showing it here. So this table represents CalPERS 3 CRBT strategies. Those are OPEB trusts. And they're showing you this returns for the last 4 years. And let's focus on 23/24. For all 3 strategies, they're overperformed. It's 11% for strategy 1 that happened to be the most popular one. So that's a great news. What that means for you for OPEB, first of all, your assets going to go up higher than expected, so your net OPEB liability will go down. But 23/24, again, because of the lag, and most agencies use beginning of year measurement date, that's only going to be reflected in your 24/25 GASB 75. For the 23/24 GASB 75 reporting, you will be looking at, for strategy 1, 6.37%. Still a little higher than we, for example, anticipated, but nothing very drastic. So investment will be performing very close to where you expected it. Very different from a picture from prior years. So I just wanted to leave it here for your information to give you a little bit of insight on what to expect in terms of your GASB 75 reporting and OPEB liabilities. That was a very brief overview, and that's pretty much all we have for you here. We do thank Batavian Associates for inviting us today to present to you. And at this point, we will be happy to take questions if you have any. Do you guys have any questions? I think everyone is still on Medicare increases, huh? you can just Google CalPERS 2025 premiums, you'll find it. Sure. Sure. That's a loaded question. By the way, we do not represent CalPERS. We're independent actuaries, and I'll let Doug take this question.
We do a capital market survey of what investment advisors think every 4 years, and they've been ratcheting those down over the years. And I think if you look at CalPERS, despite the slide I showed with the real rate of return assumption, they also are facing this. Really, when you look at their discount rates, what they're tending to see is lower expected returns for 10 years, and they get to the discount rates by assuming things will return to normalcy right after 10 years. That's how they get to the rates they're at. So I think that has a bit to do with it. I think maybe the question may be coming from, I had a slide there that showed 10, 20, and 30-year returns, right? And the 10-year was the lowest, then 20 was higher, and 30 on up. I think that's probably too short a time frame to draw any conclusions from. 10 years, that's a long time for me, but that isn't probably enough to really build an assumption on. So I'm not sure that answered the question very well, but that's just kind of some thoughts on that. Any other questions?
Okay, I think we don't have any more questions. Thank you so much for your attention, and that's all for us.